welcome back. Super happy to have Ronald on the show. Thank you so much for taking the time to join.
Thank you.
Can you tell us about your first memory in finance? How old are you, and what did spark your interest in finance or business maybe?
Ooh, that's a difficult question. When I was young, I wanted to become an astronaut. So space travel was the thing I was in. And it was not the time that I really thought, well, I want to become an investor. Maybe initially I did some administration at home and looked a little bit into my then very small personal savings. And then gradually, I think I developed a bit of interest in how you could grow that more rapidly than just put it in a savings account, because that tends to. I think it was still a time where you had this small paper booklet, and then you would go to a bank office and put some of your savings on your bank account, and they would put a stamp on it and say, well, you have saved 10 guilders in the Netherlands, 10 or 20 guilders more, and then you could see it in the booklet. I think that raised a certain interest because it grew rather slowly. So yeah, I wanted to go there to make it grow faster, and maybe that triggered some of the interest in investing. But I think it did not. My real interest in investment management did not really materialize in a significant way until my university studies, where I entered into the finance and investments area of my study, and then wrote a paper, a final assignment paper about big bank changes in the London Stock Exchange. I was a member of an investment community, like a student community, a small student association group that was investing. So that's when I really became interested in investing. Yeah.
Is it fair to say that the young Ronald will probably work for SpaceX or Blue Origin, because it's happening so much interesting stuff in space exploration and space travel? Do you follow that industry because you're curious about space exploration or not?
Well, not that close. I think it was a little bit like kid plans, and it soon it became clear that would not be my thing. But I'm still interested. Actually, scientific articles about discoveries, what is happening. Recently, I think there was an article about a black hole swallowing a star and resulting in sort of a spaghetti-like pattern. And that these kinds of articles I still follow. And sometimes maybe when we're on vacation or so, I sometimes read some books and articles, and well, we do have a telescope, and we do sometimes look into the sky with I have children that are maybe a bit too old now to be really interested, but they're still living at home, so yeah, do a little bit of that. Maybe different times would mean maybe it would mean a different choices. Who knows? Yeah.
Super interesting. I also read an article that there's unlimited amount of gold in the universe. So you can, if that's the true, that will have something to say on the gold price. I will not go into that just yet, but when you decided to become an investor, how does that thought process looks like? Because you can easily end up in BCG, McKinsey, etc. Or did you have the investor mindset after university and you pursued only investing, or did you do consultancy like a lot of other people do?
I did not. I was during my university days. I did a little bit of consultancy, which was, but one should not compare that with BCG or McKinsey. There was a little bit of a student setup, but I think some others did as well. It was a bit common in university. So with a small group of students, we offered our services to small and mid-sized companies that could not afford the McKinseys and BCGs of this world, and we offered some consultancy there. But I didn't go to a consultancy firm first. like I said, I had already developed some interest in investing, but I had not made firm choices yet. I looked in the banking sector. Actually, I also had conversations with the Dutch Ministry of Foreign Affairs to become part of the diplomat class. And like I said, at the time, I'm in the final days of my study. I was studying in London School of Economics, working on the paper about big bang changes, and working a little bit more like internship assignments in investment-related companies in the city. And that's where I think that interest in investments. Then I worked in commodity trading a bit, credits research, and moving a bit into equities already. So that's where it further developed. And then after a couple of years of doing that, a firm, Robeco, still exists in the Netherlands, a mid-sized in asset manager. They rang me and say, "Would you want to join us as an equity portfolio manager?" So that I had jobs before. I worked combined with my LSE studies. I worked in the London City 2 to 3 years, but those jobs you would call more like internships or first jobs, junior jobs. And my first real job was portfolio manager equities at Robeco. Yeah.
Super interesting. I know this is a big question, but let's start answering it. What defines a great investor? What qualities and what competence do you look for if you're hiring an investor? And I know, of course, it's sector-based, etc. But can we be a bit generalistic at the start and then dig our way down?
Yeah. Well, I think a real investor should be, should be able to withstand pressure in many ways. I should have a strong opinion. I said maybe a bit stubborn even. Be aware of different perspectives one can have. Be sometimes aware of go against. A good investor sometimes goes with the trends, but also sometimes goes against the trend. So I think you should be self-assured, relaxed, open-minded, a global perspective, a bit competitive probably. This is not only. I don't believe in star cultures that much. So we've always, and also in my current job, we believe in a team approach, but still you need to have some competitive pressure in the team to be able to get to good results and sometimes be able to beat the market. That's also part of our job, leading to excess returns. So competitive is, I think, an element. Very analytic. Ability to see and look through things rather quickly, be able to, from a big amount of information, digest it, but extract the elements that do really matter. As many interests, many sectors actually are quite simple. I wouldn't say all, but many are quite simple if you know which things you should look for. And people make it sometimes very complicated and come up with lots of information. Reading a research report, you sometimes don't know why things matter. And so you could look for the things that really matter, that really makes a business successful or not successful. Yeah.
Can we break down the analytic part? Because is it in your mind very important to be good in math and history and to deliver extremely well-structured Excel sheets? Or do you mean analytical in a broader sense, that you maybe don't know all the numbers, but you have the imagination to see and forecast and see the trends? Because I think some people get scared because they don't like Excel, they can't become an investor. How do you stand on those issues or myths?
I think it's mainly the latter. So being the ability to have a new creative perspective, combine things, look at the broader picture, deduct the most relevant information. Though I think a good investment professional does have a little bit of a broad skill set. So I think mathematical knowledge is important and relevant, but also you mentioned history, which is a good example. I think it is rather important to know what happened, even about stock exchange crashes, or things have often happened before, maybe in a slightly different way, but many things have been. So also history and also world history, I think, plays a role. And one should realize when you're young, entering into a business, usually you do a little bit more of spreadsheet labor, not only, but then afterwards. Of course, there is some years of getting experience. I remember that as a young portfolio manager, we used to, we're now talking a lot about alternative data, but that was the time that the normal data from annual reports was not readily available, or often in a way accountants present it. And the way accountants present data, it's not always, actually I would even say usually not helpful for investors, because you don't see any trends from that. So we needed to do cleansing of those data, and we, my group of new portfolio managers, were the new generation of investors then, where we would apply statistical methodology, building algorithms, cleansing of the data, ways of approaching like economic value added. So it was a more scientific approach towards asset management than before. When I joined, which was late 1980s, early 1990s, it was before people were gossiping a lot, talking a lot to each other over the telephone, try to benefit from earlier access to information than others. So I was part of a new breed of portfolio managers then, and I firmly believe that these days, for young entrants, with of course artificial intelligence and alternative data, ESG factors, new ways of analysis, that indeed we see yet another new breed of portfolio managers that are growing up now. So I would compare that with my young age, but of course I'm not ready anymore to learn all of this again. So I depend upon the young people to do all this.
Very interesting. Another question. I don't know if you are leading 900 people around the world or the number is slightly different, but a general question that I find very interesting. Should the best investor be the leader and CEO? Because normally you hire people until until they can't do their job, because a leader is not an investor. I understand you can be the CIO and CEO, but how do you view that? Because I think many firms do the mistake of making the best analytical head the leader of a group, for instance.
Yeah, I agree. Yeah, we employ, I like round numbers in a way, so I say we roughly employ 1,000 people. I think if we're growing rapidly in the area of illiquid investing, so I think we're approaching 1,000 people. And I do not believe in, like I said, in a star culture. I believe in team performance, and I believe in delegation to the maximum extent possible. And so it would be odd that I was a CIO of my company, now CEO, but suppose I was still CIO, I would make all the investment decisions. That would lead to inferior results, because you can't have the expertise in all the areas. So we hire specialists, well paid, well-educated specialists that can spend most of their time looking at the investments they need to make. Even already the time spent matters. If the CIO has only so many working hours, so he can't look at all the things. But also, I think the specialization is important. So, believe in delegation. Of course, it's still relevant for a CIO or a CEO to be involved with investment decision. I would not plead for hiring CIOs without any investment knowledge. No, you should be able to challenge people, coach people, maybe as an exception, make certain investment decisions that go against some of the insights that relate from the team, but particularly, as you already leading a little bit the suggestion, it's also about people management skills. Right? It's about motivating the team. So that's a very important element of the job. Yeah.
Yeah, like a perfect analogy. You don't want the coach to go outside and play the football game. You want the coach to motivate the players. I don't think you want Arsene Wenger running around trying to kick the ball. Can you talk a bit about the general landscape? And maybe Europe is the easiest place because, of course, many of the listeners know the Norwegian oil fund. I would not like to compare you and say you're the same, but there are similarities. Can you sort of paint the picture of the pension funds and also introduce maybe the concept of a pension fund type of model, because I'm not sure everyone knows it. So if you can keep it easy. So
yeah, no, I think actually APG is to a large extent comparable with the oil fund in a way that we the two of us belong to what we would call the asset owner group, where formerly us as APG are not asset, we are a bit of a hybrid. We manage money on behalf of pension funds, and those pension funds are very big pension funds that we stand very close to, and they're the actual asset owners, but because of the very strong partnership, we have an asset owner mentality as well. And in that sense, I think we're comparable with some funds, the oil funds, some funds in Denmark and Sweden, some UK funds, but also with the Canadian pension funds, GIC from Singapore, GPIF from Japan. And together we are an asset owner mentality, and what characterizes us, long-term investment horizon usually, strong interest in responsible investing, a bit of a value-driven nature is, I think, important. Certainly not a sell-side mentality. We're not so much into marketing. That's mainly about the science, or maybe an art to a certain extent, of investments that matters a lot. Also, a strong consideration of the purpose that you have. Why are we doing it? And that would be, of course, for the oil fund, also something that leads to a lot of discussions in Parliament. But for us, it also, for us as pension fund managers, a little bit more clear, because we want to offer people a good pension. And so we have, our purpose is offering a lot of pension value, good pension in a sustainable world, we say. So it's clear if we make less return, people get less good of a pension. But also for the oil fund, I think it's important to think about the purpose that you have. And of course, it needs to be determined and discussed in Parliament when that will be used to the benefits of the Norwegians. That's, of course, not for me to decide. But I think there's similarities around that. Yeah.
But do you also get the phone call from the finance ministry that doesn't like that you hired a person that maybe have some interest to come?
No.
So
it's that's good that you ask, because that is, I would say, fortunately not happening here. The governance is clear in the sense that we also actually are able to run a company, and there should not be any interference in the. You draw the analogy with sports. I'm always saying, well, ask me to play any sport. I enjoy sports a lot, but don't change the rules during the game. Define the field that I'm playing in, set clear mandates, and then let me play the football or the hockey or whatever within that field. And what we try to avoid, we sometimes have, of course, questions being asked in Parliament as well, but we should avoid that there's a direct influence on the investment decisions by politics or even by our clients. Our clients, the pension funds, should, of course, consider what they want. They are responsible for setting and approving the asset mix. But afterwards, of course, it should be left in the hands of the specialists to manage within the mandate. And then, of course, the specialists report back and get assessed about the results that have been achieved. And when you run a company like me, you need to be able to select your own people. I strongly believe in that. Yeah.
Makes sense. Time is going so fast, Ronald, but I think we have to spend a little bit of time on the macro situation, because in my lifetime, I've never seen government print so much money so fast, and I've never seen an environment that makes me bullish on Bitcoin, because I don't know, if we can print all the money in the world, where is the scarcity? And if the interests are negative and zero, where is the alpha? Where is the opportunities for a big fund like yourself? Can you explain the macro situation and why it's maybe harder than ever to navigate in these markets? Because it doesn't seem like we've been here before. And if we've been here before, maybe capitalism is the thing that's going to end, sort of.
Yeah, of course, we almost will get philosophical here. And I will start saying that, of course, one will always say that we are now in a situation that we have not seen before. And because we always have the benefit of hindsight. So, of course, it's now easier to explain why stock markets went up so much in the 90s, or what caused the credit crisis. And after the fact, it's always easier to explain. Now we're in the midst of a situation, and then you always say, ooh, it's such an extreme situation, how would we deal with it? Having said that, I would agree with you that is not a usual situation. And I think you already start analyzing the situation to a certain extent. What is difficult is that, of course, for different reasons than supporting asset markets, financial markets, that's of course what happened since the end of the credit crisis. Initially, a lot of monetary support was offered, and that was prolonged, and actually we're still in a situation that there is a lot of monetary support. Now, since the COVID crisis, also combined with fiscal support. Before there was a little bit of that, but actually there was some complaining from many parties, maybe also from some investors, that governments should take over some of the support to get us to good, sustainable economic growth. But now it's caused by, of course, the crisis, that now we have a combined support function, both fiscal and monetary. And one could then say, in the short run, that's good news. And that's why I think many of your audience will probably know, but when I talk to friends that are not in this business, they are surprised that year to date, the return numbers of our pension fund clients are positive. And they go, huh? Well, what has happened? We have a COVID crisis. How can that be positive? So in the short run, this is leading to strong support for financial markets, which is also somewhat explained by a different factor that we may talk about later, is the K-shaped recovery. But there is this support. But in the long run, one would of course worry: is there any exit? How can central banks move out and diminish the monetary support? And we're not that far, of course, on the fiscal side. But if this continues, also governments would maybe need to offer too much support, which is leading to, and nobody talks about this anymore, but increasing debt levels. And actually before, the debt should be moved down, and now we've forgotten about it. So that creates a difficult situation. Markets prices are rich, indeed. If you look at the all of the support, low interest rates, strong stimulus leads to high valuations. So it's difficult to find interesting investment spots. And where do we find those? Of course, there are certain segments of the markets, and that's why I talked to K-shape, because there are certain sectors that are benefiting from the situation. Those could be even, if the valuations are rich, could still be interesting. There's also parts in the illiquid markets of valuations dropping a lot, so you could pick up valuable assets, certainly in certain elements of real estate. Let's say some, and it's always what is a good price, but of course some hotels and some shopping centers could start to offer a reasonable value. There are certain areas of markets that are not been given a lot of attention yet. Certainly the alternative credit space, some of the emerging markets, that certain segments of the emerging markets offer value, but it is harder to find good investments. Is that unique? No, but it is to a certain extent special. And what worries me is indeed that there's so much support, not directly aimed for the support of financial markets, but as a side effect offering that support. And in that sense, you sometimes wonder, have we not become part of the financial and economic system? And are we not influenced too much by the macroeconomic situation?
Makes sense. I want to touch upon some points. Can we start with the central bank? Because some of the issue from my reading is that at the start, it was only about managing inflation, right? You don't want to buy bread next week and the bread cost $1,000 compared to $100 maybe. But then the government said, okay, central banks, you're also responsible for job creation, or like you have to put stimulus to the economy that we can have job growth. But then the central bank has an issue because those two are a bit trade-offs, at least at the beginning. But then I don't know if the inflation today is just like a theoretical misinterpretation that there's not a big danger for inflation because the money supply is so big. So if you take Japan with deflation, is that really a problem? Or are you really considering the possibility that all this money printing will lead to a relative big inflation that can hurt the value and the assets and the economy?
Well, of course, the risks are increasing, but the background effects are so strong that the risk for an inflationary spike is relatively low. And when you mentioned Japan, of course, demographics are a big factor leading against inflation expectations. And demographics, of course, it differs per region and per country, but demographics in a large part of the world are, of course, moving against inflation. So that is something. And also now economic circumstances are not really supporting inflation. So, but it is always a worry. Of course, there is one could think of a situation that a way to move out is all of a sudden there's a quick recovery, but still a high debt government. Then there may be an incentive also for governments to benefit a bit from inflation, and maybe central banks are not, because they have used all of their toolkit for different things, they may not be able to do take sufficient measures to prevent inflation. But I think the possibility is relatively low. And you say, I think central banks are still, I actually wonder about the opposite. I think still, when we talk to central banks, they always talk a lot about inflation, why it's not there, why it has already grown a bit, what do they expect? So I think it stands still pretty central to what they do. Of course, it should be avoided that you get political influence on central banks, and I think one could be a bit cynical, but I think to a large extent that is still okay. And then the question becomes: has the role of central banks changed in nature a little bit? In a sense, are we? You say their goal is fight inflation. Is the goal now not manage the background effects for our economy a bit? And I think, to be honest, there is a little bit of that. So the role has become somewhat broader. Is that negative? Should one complain about that too much? For now, I think it's okay. They still have the inflation target in mind. I think they're still aware of it, and if we can avoid political influence from standing in the way of acting, I think it's okay.
I agree, but I don't think you should add on, like we do in Norway, that the central bank also should be worried about the real estate market, because then you have...
Yeah.
Okay.
No, it should definitely not be, and one, that's why I added the word cynical. One could sometimes think, did we go too far? Maybe already in the credit crisis. It was eventually not in supporting the economy, was not the indirect effect of supporting certain sectors of financial markets, was that not going too far? Maybe. And indeed, if you have a direct goal, let's keep real estate prices high, that should not work. And that's not the way it should work.
Agree. Can we talk a little bit about the broader macro picture? Because the narrative is very easy. US is going down and China's going up because of the free trading world we created. So it's very easy to see, if you simulate free trading, the country with the largest amount of population and their political mindset makes it very easy for them to outgrow US in terms of growth, because it compounds much faster. Is that the only narrative that is correct, or do you see some alternative views on the next 10 years in the global economy? What kind of shifts can we see? Because to fix US with either Trump or Biden seems, I've lived there, and it seems very hard to do that in 4 years.
Well, of course, you ask. Actually, I tend to agree to the narrative. So I am a believer in China, and I see the negative sides of China. So let's not forget about that. But we have developed many ways to invest in China. So I see the main narrative. If you ask me, are there also other possibilities? One other narrative is along the route of sustainability. So one could say that that could have a factor. Actually, Europe has an alternative there. Tends to be leading the ways towards sustainable growth. If that becomes the world norm, it could lead to a somewhat different perspective and some changes in the economic success of countries. A traditional alternative way of thinking is, of course, technological breakthroughs. Though we are aware that China has stepped up and is now becoming very competitive in many technological areas as well. One could still see that in certain areas the US has still a bit of a benefit there. If we have a certain technological breakthrough even going further than today, that could also lead to shifting back a little bit from the Chinese trend. I think an alternative view is also that all of this, China may not being accepted as a world leader by many, US focusing on themselves, Europe not being able to offer a real alternative, that you get this blocks, that it becomes, we lose global perspective even more. I think there's been some opposing factors to it already in the last couple of years, but that could go a lot further, and we could become regional blocks again, with also certain parts of the world that need to collaborate with one of the leading blocks. So
can you put Africa in that equation just to finish it up?
Yeah. Africa would be, of course, by itself would probably not have a viable perspective, but they could partner with one of the other blocks. So that's of course, and also if you think in conspiracies, and maybe rightfully so, this is could be the Chinese strategy, as often talked about. Yeah.
Yeah, I mean, when China wants to build the airport in Greenland, you don't have to use your imagination. So, can we also talk a bit about, since I'm a representative of Norway, should I be worried that strict limitations on the investment strategy is a bad thing, because this climate could need that you go more into private, you go more into illiquid assets, and the strategy that the narrative is that stay in the index fund and don't do anything stupid. But the problem with that is that it's like, I wouldn't call it stupid capital, but it's very dead capital. So if you're in an index, you don't really decide what to do, right? Because the index will take care of itself. But the narrative in Norway, at least, is that you should never trust a high paid fund manager, because he can close down the fund and he's well paid off anyway, and he doesn't have any skin in the game. So I think the general sense in the population is that don't waste time on hiring expensive fund managers when you can just sit passive in the index fund.
Mm-hmm. Mm-hmm. Well, I do believe in active investing, but one could indeed, we have seen relatively good success, I think, from passive investing. So there have not been lots of reasons for people to question that. But I could point to the fact that for many of the propositions we offer, which is true for some others, we can prove that we've been able to do better than the market. But if you approach that on a macroeconomic perspective, you lose out on that. You get back to a similar performance as passive investing, and including costs, sometimes even to a lower performance. And I think you asked about restrictions, and that probably is the explanation for that. Maybe there's indeed too many investment restrictions to avoid the active investor from really benefiting from the possibilities that the passive trend offers. I think theoretically it should offer many opportunities to benefit from passive behavior, to be expected inclusion into benchmarks, investing in things that have already grown in value. So it should offer many opportunities. Maybe good investment people don't have the opportunity to benefit from that fully because of some of the restrictions that are out there.
Take real estate. It's a great example of that. Yeah. Real estate.
Yeah.
It's hard to get exposure if you don't have a lot of capital, but a normal person should be able to take benefit of a real estate market.
Yeah, true. Yeah. So I like I said, it depends on back to the discussion. Where do you draw your playing field? I think you should make it relatively broad and not too restricted. Because also lots of values to be found between asset classes. Even the simple fact, and of course it makes things better to understand, but you often talk, you mentioned real estate, but there's so many ways that you can get exposure to real estate. So there are different segments. You could be equity-like, take equity risk, you could take debt risk, you could take mezzanine risk in real estate. There's logistics, there's residential, there's offices, there's shopping centers, hotels. And if you give someone a mandate to invest in hotel equity like Norway, you restrict it very much, and maybe there's a lot more value to be found if you make the mandates a bit broader than that. So
100%.
Yeah.
I wrote an analysis, Ronald. I don't know. I will try to explain the analysis, and you can say if it's a good or bad analysis. It's about maybe your biggest issue in your job. So I will try. We live in a world where people get a lot older, right? So people live longer. So basically the population will collapse at some point. People think we have a problem with it increasing, But if you forecast to, I don't know if it's 2050, you'll have a collapse because people don't get so many children anymore. So you end up with a population which is very old and not so many young people coming after. Of course, Africa and some other countries are different because of religion, but still, let's take Europe for an example. So you also have technology. That means that many jobs will go away. Of course, they can be replaced, but maybe it will go faster this time. So you have a lot of people that doesn't understand tech can be outside of jobs. That's why we have this like universal basic income discussion all the time, because we're afraid that so many people will fall off. So then, if I come to you then, you are responsible for the pension funds, right? But you also want to have some risk in that portfolio. So you don't want to say like, I have X amount ready all the time, because you want to use that X amount to increase, right? So you have to take some risk, and with risk usually comes volatility. But if you have an environment where the people need the money all the time, it's hard to accept volatility on your behalf if you need that volatility to increase the money and the pension. So how would that scenario play out if suddenly there are more restrictions regarding volatility because we need the money to either pay universal basic income, or people need to be sure that they have the money they have in the pensions, right?
Mm-hmm. Actually, it's a quite important question these days in the Netherlands, because we are moving to that will only happen in 5 years or 6 years time, but we are moving to a new pension contract where the investments remain to be collective, but the entitlements will be seen into individual euro amounts. And then the annual returns, or even in between, will be allocated towards certain age groups, age cohorts. So you will see it growing or dropping by a certain return. And that's indeed for people that are not used to investment market volatility. So that's what you mentioned. And indeed, it's when you're not used to volatility, it's hard to handle. Which could lead to becoming more and more risk averse, and if you're not careful, end up with only treasury government related investments that yield nothing, and then you're back to close to zero returns if the situation stayed the same, or even negative returns if interest rates start moving up again, and then maybe you will regain it after it's moved up and you get a certain yield again. But in the short and medium term run, this will be hard. So I think I think it's good that you remain to setting a collective investment approach. Although I understand that people like to see their own money, and that's what we're offering. I think it's still good to benefit from collective investing. So I think you should continue to do it that way. A lot of what you said is very philosophical. So one could have, of course, one of the main factors for economic growth is growth in demographics. So if demographics are changing, becoming more productive, that will have an element that will affect the investment returns. It will be very gradual though, and also it's always one can also always worry about certain things in the future, and you will always find out that it's different when you reach that point in time. So I would not spend too much time in analyzing the demographics in 50 years. Who knows what happens. We also know that there's not, and that's what we're reminded of in these days, that there's not a one-on-one correlation between the growth in capital and the growth in the real economy. Of course, there's some sort of a link, but the whole Piketty analysis is, of course, that one can grow a lot without the other growing a lot. And there's truth in that. So there is, of course, some sort of a link. companies benefiting from economic growth, but there's not a one-on-one link. So that's also a factor to take into account.
I mean, that's so important because, okay, I can sit down and forecast the population growth on the planet the next 100 years, but given the the growth in the space industry, who knows where we send people,
Yeah.
right? And then you have like, okay, I forecasted population collapse on the Earth, but if you have people in the space, like, does it really matter what I forecasted on the planet, right?
Oh, that's a very good observation, and of course for now this may look silly. So of course one could even frown upon the plans to start inhabiting Mars because it will be such a hassle. But yeah, it's possible to live in an oxygen bubble, and maybe you will be able to unfreeze the ice that is found somewhere. But it seems such a hassle that well, maybe it's nice for some people, but of course, many times in the past we have frowned upon certain technological developments. So indeed, I think one should. I would not underestimate what could happen there.
But and also just to add on that, we can also build cities in the ocean, right? We have 70% of the planet is ocean, and I know Peter Thiel is working on those projects. So let's not be like, things can happen. But time is going so fast, Ronald. So just a couple of questions, maybe with short answers. Young people that listening to this, what should they focus on if their dream is to become an investor and work with that as a job? Because it's a privilege to have a job where you're paid to understand the world and put money into that philosophy, right? So it's not a given that people that are interested in investing will end up becoming a professional investor like you.
Mm-hmm. Well, I think it's good to be aware of all the things you can do and make use of it. So of course one always makes the mistake, and of course I also did to a certain extent, to only start to understand how much potential you have when you're young, when you've reached the age that use have gone. So make use of this time to do things. I like a lot caring about the world, caring about sustainability, caring about relations that I see in young people. I sometimes worry a bit, or would encourage to keep your motivation going, keep caring, keep going for some time. Sometimes I see young people maybe settling too much into a certain perspective. This is all not going well, and well, okay, we want to make it better, but okay, what is your action going to be? I'd like to continue to see some motivation, enthusiasm, action potential for young people. So I think you have the resources available to start working on things. So let's do so.
Just since you mentioned sustainability, because I think this equation makes sense, because in the history, the equation is that the more you use the nature, burning fossil fuel, for instance, the better the economy you get in countries, right? So they're tightly linked, sustainability and economic growth. So the narrative is that sustainability is the most important thing in the world, and I agree, because right now we only have one planet, but we can't skip the fact that if you want economic growth in a country, you usually have to use the nature in some kind of way. You need to use the resources you have available. For some, it's oil. For us, it's fish, for instance, and salmon. But it's hard to get a country to flourish without using the environment you're given. Can you explain to people why we need to view this? It's a bit more complex than you read in the newspapers, right? Because of course ESG is a very important and good trend, and you've been good spotting it, but we don't have to make it sound dumb and silly that if you like sustainability, you will have great returns, right?
Of course, not only by sustainability you get great returns. So we believe in an integral approach where we, as an investor, if you have more variables to use to assess whether an investment is good or not, the better it is. So we take into account the financial elements and take into account the ESG factors as well. And by that, one can assess, is this a good investment or not? And so we do the both. And then there was an element maybe in your question that started.
Yeah, because in history, fossil fuel is a great example. So the richest countries today use their fossil fuel. Norway is a great example, right? So it's very easy for Norway to say, stop with coal mining, stop with X, Y, Z. But that's a very bad strategy because we use the same strategy to get rich, right? And every person doesn't have to want to become super rich, but they want to shower, they want to use electricity, they want a house, you know what I mean? So it's very easy to, after the fact, say, don't use your nature, be careful, Brazil, with your woods and stuff. But you have to remember that the countries that are rich today usually use those resources back in the days.
Yeah, but one could motivate it to use it well. I think in too many occasions we are using it in a way to get abundant too soon. So that everyone may know the examples of light bulbs, for instance. Those at one time were made to break down rather soon, rather quickly. And maybe also about my phone, I won't mention the brands, but also my phone, of course, is being developed to break down in a couple of years' time. Maybe that is not always necessary. And I'm not one of those people saying that the only way you can create sustainability is by negative economic growth. That's not what I'm saying. I'm still in the camp of positive economic growth, but I think one should carefully consider how to use the resources that you have to get some growth going. I clearly believe in technology, new possibilities. Space could be an example, but there could also be other possibilities. There are many interesting possibilities to to produce energy, and maybe indeed one should stop picking on fossil fuel in the past. That plays its role. We also did not blame our long ago ape-man-like predecessors saying that they use wood to make a fire. One should also put something in the context of the time, but I think it's now time to come up with new alternatives to produce energy, and that's true for many fields.
100% agree. We're closing in, Ronald. Thank you so much. I don't know if there's anything you want to share with the audience. The conversation went fast, but do you have some life principles that have guided you that you could share just to end the conversation? Because you seem like a guy who's just been more as a caring about giving value, like learning stuff, sharing, and that's like the journey, right? So is there something you can share just to sum it up, the conversation?
Yeah, well, I find it very important to remain authenticity, be open-minded. I have a very scientific interest. Also in my young years, I did a lot of academic stuff. I think be who you are, and but also not start being who you are could also lead to being arrogant. So I know better. That's of course not what you should do. So you could say, well, I believe in certain things. I'm authentic, but keep open-minded and listen to input. And then I think be patient. Do your thing, make use of the resources that you have, but don't try to hurry too much. I always felt my career went, but this was not like a steep curve. You gradually grow into a certain aspect and enjoy every stage. But before you know, you're already thinking about retirement again. So but be patient and let it happen, and then enjoy. And then, of course, when a new step comes on your horizon, you should take it, but not always worry about the next step already, because then you never enjoy what you're currently doing.
Perfect ending. Ronald, thank you so much for taking the time to join.
Thank you. It was nice.
Hi everyone, Christopher here again. Just a few things before you leave the show. If you like this episode, it would be great if you could give it a review and also share it with your professional network. If you want to get in touch with me, Twitter is the place. Just go to @ChrisVonheim. You can also find this information in the show notes. Hope to see you tune in to the next episode, and take care.